don't let the tax tail wag the dog. Do not get married because it puts you into a better tax bracket. So one, you want to be on solid footing, because if you get married for taxes and you get divorced, your tax situation is going to change. I've been a CPA for 10 years now, and pretty much anything tax-wise in the US, I've pretty much seen it. I've seen the good, bad, and the ugly, especially when major life events happen, such as a death, such as a birth of a new child, or change in marital status, whether you're getting married or getting divorced. I've pretty much seen it all. Whenever you have a life-changing event, I'm gonna go with having a child. For every child that you have, you get a $2,000, or at least in 2023, a $2,000 tax credit for each dependent child that you have, basically one that you give birth to and one that you support financially. What happens is a lot of people, year to year, they pretty much make the same money. However, when they have kids, like I said, each year you get $2,000 tax credit, which helps lower it by that. A lot of clients I've had is where we have them save for taxes each year. Normally they owe anywhere between $3,000 and $4,000. Well, one year they had twins, and I said, hey guys, you actually don't have to make your estimates this year because you have 2 new tax credits coming. And they were like, oh my God, this is amazing. We can actually invest that in our retirement. So I was able to help them get into the market faster instead of waiting until the next year and saving their taxes. So it's one of those things you just want to plan ahead. As long as you are working with somebody that can help you plan ahead like that, you're going to avoid any speed bumps and help you get to whatever your goals are faster. One of the biggest life events that happens, at least from a financial standpoint, is divorce, which nobody really talks about that much. A lot of the laws changed in 2017 when the Tax Cuts and Jobs Act passed, so I'm gonna focus on everything post-2018. Whenever somebody gets divorced, right, one spouse typically earns more than the other. Statistically saying, most males when they get married earn about $60,000 to $70,000. Most females earn between 30 and 40. So it's essentially males make twice as much as women. However, when you get divorced, there's things like child support, there's alimony. Child support is actually not tax deductible for whoever's paying it, and is not taxable to the person receiving it. So one person is happy because they're getting tax-free income. The other person is not as happy because they get tax or non-tax deductible money that leaves their paycheck and it doesn't impact their taxes, which kind of sucks. So you want to be looking at different ways to strategize. For example, if one spouse is paying child support to the other, maybe they get to claim all of the children, or you can split it. There's so many different ways. And at this point, you really want to talk to a divorce attorney, not necessarily a tax person, because there's so much more that goes into divorce than just a child tax credit, but every little bit does help. One of my clients, they share custody with an ex-spouse, and the way that they worked it out is in even years, my client gets to claim the child as a dependent. So they get that roughly $2,000 tax credit every year. In odd years, it goes to the ex-spouse. So we have to tax plan for that because we know, okay, she's not gonna have this $2,000 deduction every other year. So every odd year, we have to plan for an extra $2,000 in taxes. So that's one thing you have to navigate. Some people have 2 kids, they just split both of them down the middle. One gets one gets the other. And it can get really contentious. This is why I say you wanna talk to a divorce attorney at this point, because there's so many other things to worry about other than like a tax credit for $2,000. In terms of managing changes in divorce and income level, it's really case by case. You have to see like what other things are. Because for example, let's say there's a mother that was a stay-at-home mom and they're getting divorced and now they're getting child support. If they're able to claim all of the dependents that they have, they could potentially qualify for what's called an earned income credit, which is, it's a pretty big amount of money. It could be anywhere from $500 to like $8,000 or $9,000. So it's a big deal, whereas the husband or breadwinner is losing out on that income credit. It's not so much you want to work with a tax advisor, you want your tax advisor to know what the divorce lawyer is doing, because then they can work in concert. The CPA is generally going to follow what the divorce lawyer says, but you want to be in the loop. You don't want to be surprised. If you like the video you just watched and you want to learn more about how to plan for tax in advance, make sure you watch the video there. It's going to tell you everything that you need to know on how to prepare for your upcoming tax season ahead of time.
Yeah. Back and I'm better than ever. I think I got a vendetta. Oh, now they call me, I seen them. All of those times getting severed. I told them all